Look in our investment market update, a look at the economy. If you notice each time that we've had one of these updates, the market seems to be in a correction. That always keeps things interesting. In this presentation, we'll share some key economic and fundamental drivers of the market. However, again, a reminder that we seldom make investment decisions simply based on just economics until we see things confirmed in other ways, such as pricing patterns. We really don't act simply on observations about the economy. We're required to remind you of some things I hope you'll always keep in mind, which is this information is for really general informational purposes, should not be considered an individualized recommendation. It's not personalized investment advice, and the strategies we discuss may not be suitable for everyone. Each investor needs to review their own situation with their advisor. And as always, any kind of investment can lose money in certain market conditions, and any forward-looking statements we make may or may not actually materialize or prove to be accurate. So most of all, consider your risk before acting. So always look for things that are not necessarily within the investment markets or economics, just sort of as a metaphor for what's going on in this point of the markets. And tonight I'll be using two of those. One is Mr. Einstein, the quote that I ran across from him, and also we'll be looking at the year 1969, which is an interesting parallel to gain perspective on where we are now. So Mr. Einstein, this quote I happened to run across, quote is that we really need to learn from yesterday, and that's particularly relevant because if 1969 was the last time we were in a similar situation, most advisors simply were not living and practicing. Some were not living, some were not practicing during that period. So we need to go back and look at what that can teach us about today. We need to be focused on where we are right now and any actions we need to take, and we'll talk about those. And then also keep that in the context of tomorrow, which is our financial plan, and make sure that whatever's going on today, whatever actions we take, are consistent with our longer term strategies. And one of our values at Affinity has become to always question everything, to be intellectually curious. And I think by asking ourselves to examine what periods would be similar to today, we can answer certain kinds of questions that may arise with these markets. We've obviously just gone through a significant choppiness in the U.S. stock market. And some of you got very nervous because the press announced that we'd had the third largest point drop in history. Of course, the press did not mention that since the markets are up so high, that point drop was really not nearly as large in a percentage terms as previous kinds of corrections. But we did go from a record new high to a negative in just a week. And that's the third scary kind of correction type pattern we've seen this year. Now, this chart is every stock market year since 1980, and it shows that drops of about 10% are very normal. You see the red letters there that really tell us the amount of down market in that year. And so what's unusual really is from the right-hand side, if you go back to last year, we only had a minus 3%. And the only other time that really happened was about 1997. So it's quite normal to have a 10% down, 11% down, 12% peak down, and yet you still see how many years end up positive, even though almost every year we have a significant correction. So this reminds us that corrections are fairly normal, maybe even 2 a year are normal. This year is just a little unusual in that we've seen 3, but that's kind of unrelated to where we're going to end up at the end of the year. So we need to relax, particularly unless we see a correction beyond 10% or so. So this could be just your correction going through a period of uncertainty that's quite normal in the markets. For us, one of the key drivers at all times for markets is earnings. And the market in 2017 was up significantly above 20% because earnings were going to be up above 20%, and that turned out to be the case. We got about a 23% growth in earnings. Now, going forward, we're still going to see growth in earnings, but you can see that in the next couple of years, we expect those to slow down to 9 or 10% next year, and maybe 4 to 6% in 2020. Now, it's not that earnings are going down, which is a recession. It's just that earnings are going to be much slower, and maybe half of what the growth rate is half of what we've been experiencing. So the market is digesting that, and that's a big part of what's going on. We don't have tax cuts like we did last year, but interest rates are still relatively low. Consumer confidence is good. So if we get these kind of earnings that we expect in the 9–10% range, we'd be fine because margins, profit margins, are holding up quite well. And although we have slightly higher interest rates and higher wages, companies are still going to turn in some pretty nice bottom line earnings, which should help sustain a somewhat stable market going forward. So you can kind of put this in perspective on this chart on the left here. This is the S&P earnings. You can see obviously we had no earnings in 2009. Companies just did not turn in operating earnings. But look at how they've grown, and look at the recent period, including the projection of the next couple of earnings cycles here. You can see that we've really got a long term, going back to even the year 2000, of kind of a trend toward larger and larger earnings. And of course, the stock market should reflect that despite the corrections along the way. One of the reasons that we've seen such a nice steep climb here is starting about 2014, even 2013 really, we started to see enormous stock buybacks. Companies can get capital so cheaply that they're using it to buy back their stock. So if their stock gets cheap, they simply buy a lot of it. Now, that's gone on. It's been a big reason, maybe a third of the reason supporting the increasing levels of the markets. But look at 2018 on the right, the orange line. Just when we thought that earnings buybacks were remarkable, 2018 is literally off the charts. And with this going on, it's going to be very hard to see too much of a correction in the stock market, because every time stock prices go back, the companies are basically taking their capital and buying the stock back, which drives prices up. And of course, executives win on their bonuses whenever these earnings per share go up. And that's essentially what buying back their stock creates for them. And so we expect this to continue in sizable amounts. So I think a big supporter for the market going forward, and a reason for some confidence, is this continuing buyback story. So one of the things that drives me a little nuts is if you're watching CNBC or some other news show, or asking for some expert's commentary on how the markets look this year, they often say quite casually that by many measures, the market is of course expensive. And that's just simply not true. If earnings go up 23% and the markets have only, gone up really this year by 2%, 3%, then obviously the value of the market's gone down, and that's what this chart shows. We're somewhere between 16 and 17 times earnings at this point. So a lot of different valuation measures will say the market's expensive, but by the simplest one, which is what price do I have to pay to get corporate earnings, we're not expensive. Normally markets have corrected in the 19 to 22 times earnings. As you can see, back in 2000, markets got up, a growth market somewhat like we have now, got up to 24 and 25 times earnings. So the market is actually cheaper than it was late last year. So that again is supporting that we should see stable to up markets going forward. So let's confirm that. Like we say, we look at something like that and say, okay, those are some interesting arguments for a positive market. Well, what's going on in the market technically? What are prices doing? Because obviously they've just taken another leg down. And you can see in the pink area to the right there that we have seen a couple of tests to the low end of the market here, a couple of corrections this year. But you can see that we have not penetrated the trend line that we started since coming out of the big correction in 2009. And several times we've been down to the level we've kind of gone to the bottom of that channel, but we have not penetrated. And if we look at the 2000, 2007, the big difference, of course, is they broke down and sharply broke below the trend line. So if we see it breaking below the trend line, then we would say something has changed. But the bullish outlook says as long as it stays above that trend, it could break out on the upside as well. So we're going to wait and see it resolve and make sure it doesn't go below the trend line. But we expect that you might see a bounce back to higher levels given the technical chart pattern you see here. So again, here are three measures this year. The blue and green are the QQQ and the IVW growth, which are held in a lot of portfolios. And you see the drama back in February, the last time we started a year with a correction. And of course, in March at our meeting, we were just coming out of a correction there, and then a lot of drama. And if we come all the way up, we see the drama that we're currently going through. But you can kind of see that despite all the drama, these markets look like they want to trend higher, but they keep kind of correcting down. But we were in the right place, at least in the growthier side of things. We've still managed to do better than the indexes by focusing on growth. And again, strong bull markets are resilient. They can be tested, but then they will break back out on the upside. We break the trends. If we don't see that resilience in the market, we operate on a simple concept. If a bear market shows up, meaning we go down 12, 14, 20%, we're gone. We're going to go to cash and defensive positions because you don't want to get in the way of those big bear markets we see, every 7, 8 years. But right now, we haven't seen a bear show up. What we've got so far, at least, is just a correction. So what are going to drive markets? We've mentioned a little bit about earnings, but here's some of the other things that we think are going to make a big difference. As we said, right now labor market's at a 3.7% unemployment rate. That's the lowest rate since 1969. We have 7 million job openings and about 3 million people wanting those jobs. So that's a mismatch. And so at this point, the labor and employees are quite confident that if they lose their job, they can get another one. And they're quite confident they're going to get a job, or they're also confident to ask for a raise. So tight labor markets are driving things. We've got a Federal Reserve that essentially feels that interest rates are still near zero. Now you say, well, they're not at zero, but when they say that, they mean the real rate. The real rate of interest rates is the interest rate, often quoted as a 10-year interest rate, minus the inflation rate. So right now, you could say the 10-year rate is about 3%. And if I take away 2% inflation, I've got about a 1% real rate. So that's very low by historical standards. And so the Fed says maybe the low rates could cause inflation. And we'll talk about a similar kind of situation that they faced in 1969. So the Fed is going to continue to raise rates starting in December again and maybe twice next year. That's a driver of markets. Now, last time we also talked about how technology is the core of the market climb we've seen in the last few years, and we think it will continue to be. But it's slowed down and is currently in this correction. It's the first time we've seen tech stocks get corrected. So I want to talk about what's going on with technology and the coming phenomena of 5G networks and what that can mean. And of course, everybody's talking about tariffs, and tariffs went from being a casual issue for us in the spring when we talked about this to being a pretty serious matter at this point, because in the spring we had strong global growth all around the globe, expecting stronger growth. We still have most of the world growing, which is a good positive environment, but we're not seeing the levels of growth outside the United States and China that we would have expected. So that's going to be a factor going forward. Talk about each of these. Did want to mention 1969. So in 1969, here's some of the things. And if you like 60s music, you always, if you're like me, you listen to 60s and it's hit after hit after hit. But that's all of the years of the 1960s. If we go to one year, there's only a few great songs. And if we go to this week in 1969, here is the list of songs that were very popular. And this is the last time we were at 3.5% unemployment at this point. And it looks economically somewhat like now. Does anybody remember what the #1 song was? I didn't care that much for Gene or Tracy by the Cufflinks. But what was the #1 song for that? The Can't Get Next to You by the Temptations. Now we're talking, that's That makes the all-time 60s list as a great song. And this in 1969 ended what were called the go-go 60s, where we had very strong stock market growth like now. We had low unemployment, and we had the Fed beginning to increase rates just like this. So what did that do? Well, one conclusion you get right away when you look at the 60s is that it's, of course, remembered for the moon landing, and I remember that. But Donald Trump was just a kid playing with models of buildings in New York. Hillary was a geeky looking attorney, and I was sitting in North Carolina wanting a Charger RT as a teenager. But one of the things, if you go back to 1969 on this chart, you see it was right before recession. And you can look at previous periods. The lowest unemployment in recent times was in 1953. It turns out that unemployment rate, which got down even lower, was also right before recession. So it's quite possible within a couple of years of peak labor usage, you run out of workers, wages go up, and you get a recession. But you can see even in 1969, it took a couple of years after that, we really got a very brief recession in late 1970. And then it was really 1974 before we really got a bearish kind of a recession. So when there's very strong growth like we have now, if there is a recession, it's generally very brief because the economy is so strong that things don't correct that much. In fact, that was one of the shortest recessions we've ever had, only about 4 months until things started to recover. So we certainly should be on the watch now if unemployment goes any lower, that we're within a couple of years of a recession, and that wouldn't be good for stocks. So what's really going on, of course, is the Federal Reserve is trying to keep us from getting overheated. And so they're trying to do what's called a soft landing. In other words, slow things just enough so that we don't get inflation, but also trying not to wreck the markets. So one obvious question is, how good are they at this task? And let's look at history. Very important. If you look close at what looks like a complicated chart, it's not so much. If you look at the red line is the interest rates that they can influence, which is the very short rate. This is the rate that banks pay to get money. So they get money through the Fed, and they lend it out to consumers, and that difference is where they make their profit on loans. So when they raise rates, banks have to pay more for the money, therefore they have to charge higher interest rates, and fewer people take loans, and therefore there's less business activity. Well, let's look at this. Okay, if you go to the left side of the chart, notice that when the red line, which is the short rate, crosses the blue line, which is the 10-year rate, we get what's called an inversion. And one of the more certain economic patterns we always see is when there's an inversion, we get a recession. So the Fed starts to raise rates in 1961, and they continue to raise them. At first, that's not a problem. If you look up, the green line is the S&P 500. 60s were very good for stocks, and you can see that basically stocks rose all the way until 1970. But again, we got the inversion about 1967. Didn't get an immediate recession, but then they took it well above the 10-year rate in 69, which is a period like now, and brought the market, as you can see, we got a recession and down goes the market. Well, it was only 4 years later, they raised rates quite sharply. Had short-term rates, which today are 2%, short-term rates got to 10%. Over 10%, and we got a deep, ugly 1974, the year our firm was started. 1974 had back-to-back sharp down corrections, a recession, and you can see the market took a substantial hit in 1974. Well, the Fed didn't get it much better in 1979. They started raising rates again. These were the Volcker attempts to get the inflation under control from 1980 and 1985, and by 1985 they had gone all the way to 17, 18% rates because they really wanted to stop inflation. And that, of course, caused the market to correct again. We got a significant kind of recession in 82 that lasted quite a while. And then rates began to fall and have been falling ever since, really. You can see that rates fell for much of the 1980s. We only got one brief inversion, really. Well, two. You can see 1986, which kind of led to a brief correction in the market, a little bit of a fall off a cliff there in 1987. But that was quickly a bounce back. And the next time in 1990, roughly, we got another inversion. In 1991, we got a brief recession. The market went down. But then we had a wonderful decade from 1990 to 2000 during the dot-com boom. You can see inflation was now in control and rates stayed pretty stable to flat, moving sideways. But then late in 2000, they finally jacked up rates again, and here comes the crash, really, of 2001. So again, we got the same thing in our last big correction. The Fed started raising rates in 2004 and had them pretty high by current standards, above 6%, and we got that ugly bear market we got last time. Now, right now, the Fed has been very restrained and made very easy money policy. Look at 2010 to 2016. What a difference, right? Rates near zero. Historically, never done before, as you can see. And we have not inverted. We have not gone above the curve. I think if we go above the 10-year, that's going to be a recession. But right now, we really have not crossed that pattern that usually brings a. We're still expecting growth, therefore. And you can see here, this is the growth rate, right? The big tax cuts were supposed to bring about 3% growth rate. Well, we got that, really. We got a 3%. We just got the recent numbers for the last quarter. Again, showing about a 3.2% growth rate, very strong. And this growth rate is causing people to think the Fed will raise rates and therefore cause the inversion. And that's a bit of the concern. But it's also good for stocks because a growing economy creates profit. So I talked about the Fed as a driver. We've talked about high unemployment. Let's talk about technology a little bit. There's two big parts of technology, right? One is the cloud and software world, which is continuing actually to do quite well. And there's companies like Microsoft that are big leaders there. Even Amazon are holding up pretty well. They've corrected a little bit, but not that much. But these semiconductors that are a very bullish long-term opportunity started off, as we talked about last time, moving upward and moved up all the way to the end of September. They were up by as much as 10%, but they suddenly have given that all back. So something happened at the beginning of October, and of course that was the implementation of severe tariffs on China. And, for some of these semiconductor companies, they earn about 30% of their earnings in China. So that was quite serious for them to get this kind of impact. And you see that the semiconductors kind of fell off a cliff and have actually managed to be negative after a big positive start to the year. But something else is also happening with these, and that is the coming of the 5G phenomena. And 5G is really changed a lot of our thinking about technology. Um, 5G is different than a point-to-point network. Essentially, Verizon, Comcast, and other providers of networks are going to shift the standard from 4G, which is what your phone operates on that you're familiar with, and they're going to a new architecture for technology called 5G. And 5G uses all new chips. So if you think of 5G, think of like a spider web. Okay, instead of going from your phone to the cell tower or from your phone to the server in your house to the tower, the signal is going to go by 100 different routes, all going to local servers. They'll be on every telephone pole on the side of your house, throughout your house, everywhere you go in businesses, and particularly up and down highways, you're going to see little relay signals and little nodes on the network. So therefore, you don't have to worry about overloading a single point to point. You can go around that, and the chips that do this know how to route signals through that network. So we need very sophisticated chips for this, because one of the things this does is allow your car eventually to talk to other cars so they don't run into each other. That's going to be a key to getting true self-driving cars safely. And so old chips that don't do that are beginning to be dumped by the chip makers, and companies are slowing down their orders because they want the new chips, And that's creating a little bit of pricing difficulty for the chip makers. Now, they're going to print profits enormously once we get a transition. So the question is it worth trying to be cute and move completely out of the chips and try to get the new phenomena when it starts to happen and time that? Or for the most part, should we hang on in some of these? Now, in our case, we don't just buy the chip makers, we really own them. Some of the leaders in this, like Verizon, Comcast, are in the QQQ or the growth indexes you own. So other companies can be growing and they kind of offset this phenomenon that's going on. And when the chip companies start really going, they're going to drive those indexes to even higher levels. And so this is an important transition that for this month and next month, they're kind of getting played out as these companies make a transition to new chips. It's a big driver underneath these markets. So finally, everybody's paying a lot of attention to tariffs, and we just put another round of a couple $100 billion dollars of tariffs on. We did work out NAFTA. I think both China and the United States are digging in to try and really take a strong position on these disagreements, and so this could go on into next year. Again, the U.S. has an advantage because we're not a big exporter. It does hurt certain parts of our economy, like the chip makers. But overall, we're in a much stronger position than China is, which really needs this global trade. And they're trying everything they can to try and make deals with others and so forth. But it has hurt them. Their markets are down about 30% this year. But overall, this chart shows on the right is mostly green as we go into 2018. And that's holding up pretty well. We're not getting the growth rates we thought. And as a result of that, we are seeing some slowdown, but mostly it's a pretty positive environment out there. We did, however, move away from international mainly because with higher interest rates in the U.S., the dollar is strong. And with the strong dollar, you don't want to be invested overseas because then you have to take the earnings there and translate them to dollars, which kind of offsets your gains. So we moved out of international a little bit. But generally, we have a positive international environment, except between the U.S. and China, of course. So remember, we do have some warning signals. If this is more than a correction we're seeing right now, we will see consumer confidence fall. And consumer confidence is just a little softer, but it is still at historically high levels. So before, as you can see, really in the last two, if you look at this, you'll see before the last two recessions, you saw consumer confidence really turn down. We are not seeing consumer confidence go down. It's one of the reasons we're pretty sure this is a correction. Now, the other thing we need to watch is will growth slow down? We just got the numbers in. We're still seeing, we went in this year with a 2.4% annual growth rate. Now we're thinking it's probably going to be about a 3% growth rate. If we get a 3% growth rate, very unlikely we're going to see markets do more than a brief correction. So, but people say, wait a minute though, we're almost 10 years into this correction and the markets are, have gotten high. So we must be due for a bear market or recession. But as you can see, both in the 1980s, we had a 13-year, run in the stock market that took stocks up by 19% a year, and we made 845, 8 times our money. So one of the reasons we don't get out of this market is what if it's actually going to go another 3 years and we get another 300% rise in stocks? That's not impossible because we've got a good growth rate and we don't have high valuations. So if we got much higher valuations, much higher earnings, and a good growth rate, this market could actually go much higher. And same thing actually happened in the 1990s. We're almost 13 years again, 19% returns, over 800% that we made during that cycle. And we've only made about a little less than 4 times your money this time. So it's not unusual at all that this market could go quite a bit higher. Now think of what this is saying. You can make 100%, you could double your money once again before this whole cycle is over. That's why we're not anxious to move out of the markets to try and play defense. So what are we doing here at Affinity about all this? Well, we think that if you look at each of those drivers, because of tight employment, we think companies are going to try and replace people with machines wherever possible. One of the places is clearly by using what's called cloud technology. That's why a lot of you own the SKYY or you own the Triple Q, which also has a lot of these big companies like Microsoft that will participate in the cloud. Amazon's another one. We are staying out of construction, agriculture, trucking, these industries that have tremendous acute shortages where it's going to limit the growth. So we've stayed out of home builders and some of the other areas. We are trying to own, we have consumer discretionary in some or other kind of retail or consumer oriented indexes because with higher wages, we think we're going to get a big Christmas season. So we are trying to exploit that. We also think smaller companies actually had gone very well when we bought them, have given back a lot of those gains, but they're still slightly positive. We think they'll do better because they are kind of immune from all this tariff action. And in this good of economy, those small companies can attract workers who are willing to take a little more risk by joining a small company. With the Federal Reserve as a driver, we do think interest rates are going up at least once, if not twice more. I actually hope they don't go 3 more times because that would be an awful lot of strain on the markets. That is a little too much. I'm not sure they're loco, as Trump would call them, but they are being aggressive with these rate hikes. So what we're trying to do is all the managers you have on your bond side, if you have bonds, if you're conservative, you have as many as 4 bond managers. All of them have short duration. So they're willing to give up some return to protect against interest rates. So we saw some declines as the Fed has raised rates, but I think you're going to see maybe a little less because they are very short. In other words, they own 3-year, 4-year bonds, which don't have the same volatility. We have added some high yield in some of those, and that's giving you more income. So eventually, as yields rise, you get more income, and that offsets any effect of interest rates. We haven't yet gone to utilities and consumer staples or real estate, some of those things that really can be defensive, because we're not sure that this cycle is over and this may be just a correction. That would change if we think that if rates keep going up and finally get high enough, we think things are slowing down, then we would move to those defensive positions. We did lighten up in the middle of the year on international and emerging markets because of the strong dollar, and that's good because that's actually gone on to be even a worse loss. So it was good we moved out when we did. The technology driver we've talked about quite a bit, but we do still hold the Triple Q in all portfolios. Even Mike's clients will note that you have a position there that's doing very well. We also have in some portfolios the SKYY, which is cloud computing. We do think that the big quality tech companies will do just fine. And we also gained some small innovators, companies like Cloudera that are in the small index, the SPSM that we have. And of course, we're looking at price charts and some of the price charts for indexes because that tells us when that next winter starts to arise, we'll pick that up from a technical point of view. Finding global growth, we're just going to see how this plays out. We are being a little careful and light with industrials and consumer staples because they get a lot of sales overseas and the dollar really can restrain their growth. We've reduced our European and emerging, but when things settle down, we might be wanting to go back in there because the valuations are very compelling overseas. They have not yet had the big growth wave that the U.S. has had, and they could have that ahead of them. So if conditions improve there, we're willing to go back in there because usually those cycles are 3 or 4 years, and this time around they weren't. They were only a year, but that's unusual. We would expect eventually overseas will give some opportunity. And we'll know that when technicals start to show us it's time to go back in, particularly emerging. And there is one big positive of all this international issue, which is once there's even good talking going on with our trade partners about ending tariffs, the market will go very strongly up because right now they are really worried about the worst case in terms of tariffs blocking trade. We do think there's enough growth around the globe that we are holding a little bit of things exposed to oil production because with Iran out of the picture and Venezuela struggling to produce oil and a lot of sanctions on the Russians, we think there's a chance oil may rise. The inventories have been coming down, so we do have some. And we own a lot of quality growth companies and companies like Apple and Amazon and Microsoft and Facebook and Google, which is Alphabet, Intel, Cisco. All these are rapidly growing companies. And you may not know that you hold them because you see the QQQ on your statements. That's the index that holds all these high quality growth companies. We think that's the other opportunity is good, solid, big name, growing companies. Of course, we always ask ourselves at the end is always, what if we're wrong? Well, one is we'll know that because the charts will break down and we'll go through those support levels we looked at. We also measure relative strength. In other words, the strength of cash and short-term holdings will go up, and we'll know it's time to include more defensive positions. We'll see breadth go down. Only a handful of companies will be doing well. That's a warning, and that'll cause us to move. And this looks like a 1 or 2 month kind of sluggish market or down market. If we saw that go beyond 3 months or so, it would cause us to look again. Also, if utilities and consumers, staples, which are defensive companies, dividend payers, all that, if they start to surge, that would tell us that, and outperform the growth companies, that would tell us it's time to rethink and we would make a change. If we see high yield defaults rise, and so far they're holding up extremely well, we have not seen any rise in defaults. That's a very good canary in the coal mine that would change our view. If home inventories back up and homes sit on the market for 4 or 5 months, that would cause us to move defensively. If car sales, which are going at about 17 million units a year in the United States, if there was a sharp drop, we would certainly react to that. And if the dollar were to change its current position of being strong and go soft, that would make us reevaluate where to deploy capital. So we always ask ourselves, how will we know when to make a move? Right. Well, everybody applauds something more positive. Let's leave this on a positive note. Jim ran across this chart, which I think is very interesting, is we're probably going to see this uncertainty up until the midterm elections now, about a week and a half away. But in all of the periods since going back into the 50s of a midterm election, every single one has actually been positive afterwards in the next 12 months. So with some very nice gains. So part of what's going on is uncertainty. Actually, I think we're going to end up in gridlock with the House in the Democratic hands and the Senate in Republican hands. And the markets like gridlock. They want the government to do as little as possible to mess up a very strong economy. So that should give you a little warm and fuzzy as you look to the end of the year here that we could bounce back nicely as we've done 17 times in a row. I really want to thank you for letting us share our thoughts about these very interesting markets. I do think we've got a correction here and not the beginning of a recession or bear market. We just don't see the signs of that. So we are cautious and watching what's going on, but we're staying committed that we're probably still in a longer term bull market until we get a recession or things change. I want to also thank you for your loyalty to Affinity Wealth Management and appreciate your allowing us to service your portfolios. Please contact your advisor with any questions about this material and good positive investment results to you. Thank you.